Assalamualaikum warahmatullahi wabarakatuh and good afternoon everyone. We are from group 3 of auditing 1 of in international accounting degree. We will be presented about section 404 audit of internal control and control risk. But before that, let me introduce myself and my members. My name is Richard Julian Antonio and my members are Ryan Sidkira Ditya, Jeremia Aprilianto Maldin and Nadratul Hikmah. There are 8 learning objectives that will be presented in this presentation. The first and the second learning objective will be presented by myself. 1. Describe the 3 primary objectives of effective of internal control. A system of internal control consists of policies and procedures designed to provide management with reasonable assurance that the company achieves its objectives and goals. These policies and procedures are often called controls, and collectively, they make up the entity's internal control. Management typically has 3 broad objectives in designing an effective internal control system. First, reliability of financial reporting. Management is responsible for preparing statements for investors, creditors, and other users. Management has both a legal and professional responsibility to be sure that the information is fairly presented in accordance with reporting requirements of accounting frameworks such as GAAP and IFRS. The objectives of effective internal control over financial reporting is to fulfill these financial reporting responsibilities. The second one is efficiency and effectiveness of operations. Controls within the company encourage efficient and effective use of its resources to optimize the company's goals. An important objective of these controls is accurate financial and non-financial information about the company's operations for decision making. The third one is compliance with laws and regulations. Section 404 requires management of all public companies to issue a report about the operating effectiveness of internal control over financial reporting. In addition to the legal provisions of Section 404, public and not for-profit organizations are required to follow many laws and regulations. Some relate to accounting indirectly, such as environmental protections and civil rights laws. Others are closely related to accounting, such as income tax regulation and anti-fraud legal provisions. Next slide, please. 2. Contrast management's responsibilities for maintaining internal control with the auditor's responsibilities for evaluating and reporting on internal control. Management, not the auditor, must establish and maintain the entity's internal controls. Two key concepts underline management's decision and implementation of internal control are: the first one is reasonable assurance. Internal controls are developed by management after considering both the costs and benefits of the controls. The concept of reasonable assurance allows for only a remote likelihood that material misstatements will not be prevented or detected on a timely basis by internal control. The second one is inherent limitations. Internal controls can never be completely effective regardless of the care followed in their design and implementation. Even if management can design an ideal system, its effectiveness depends on the competency and dependability of the people using it. Next slide, please. Management Section 404 Reporting Responsibilities. Section 404A of the Sarbanes-Oxley Act requires management of all public companies to issue an internal control report that includes the following: a statement that management is responsible for establishing and maintaining an adequate internal control structure and procedures for financial reporting. And the second one is an assessment of the effectiveness of the internal control structure and procedures for financial reporting as of the end of the company's fiscal year. Next slide, please. Management's assessment of internal control. Management's assessment of internal control over financial reporting consists of 2 key aspects. First, management must evaluate the design of internal control over financial reporting, and the second one is management must test the operating effectiveness of those controls. The first one is design of internal control. Management must evaluate whether the controls are designed and put in place to prevent or detect material misstatements in the financial statements. Management's focus is on controls that address risk related to all relevant assertions for all significant accounts and disclosures in the financial statements. And the second one, operating effectiveness of controls. In addition, management must test the operating effectiveness of controls. The testing objective is to determine whether the controls are operating as designed and whether the person performing the control possesses the necessary authority and qualifications to perform the control effectively. Next slide, please. And this is the example section 404 management report on internal control over financial reporting. Next slide. Auditor's responsibility for understanding internal control. The auditor obtains the understanding of internal control to assess control risk in every audit. Auditors are primarily concerned about controls over the reliability of financial reporting and controls over classes of transactions. The first one is controls over the reliability of financial reporting. To comply with the second standard of field work, the auditor focuses primarily on controls related to the first of management's internal control concerns, reliability of financial reporting. Financial statements are not likely to correctly reflect GAAP or IFRS if internal controls over financial reporting are inadequate. The second one is control over classes of transactions. Auditors emphasize internal control over classes of transactions rather than accounts balance because the accuracy of accounting system outputs depends heavily on the accuracy of inputs and processing. For example, if product sold, unit shipped, or unit selling price are wrong in billing customers for sales, both sales and account receivable will be misstated. On the other hand, if controls are adequate to ensure correct billings, cash receipts, sales returns and allowance, and write-offs, the ending balance in accounts receivable is likely to be correct. Next slide, please. And this is the sales transactions related audit objectives. Auditing responsibilities for testing internal controls. Section 404B requires that the auditor report on the effectiveness of internal control over financial reporting. To express an opinion on these controls, the auditor obtains an understanding of and performs tests of controls for all significant accounts balances, classes of transactions, and disclosures and related assertions in the financial statements. And the next two topics will be presented by Jeremiah Aprilianto Malding. Jeremiah, time is yours.
Thank you, Richard. The next learning objective is about explain the 5 components of the COSO internal control framework. The first is control environment. The control environment consists of the actions, policies, and procedures that reflect the overall attitudes of the top management, directors, and owners of an entity about internal control and its importance to the entity. To understand the control environment, auditors should consider the most important control subcomponents. The first is integrity and ethical values. Integrity and ethical values are the product of the entity's ethical and behavioral standard, as well as how they are communicated and reinforced in practice. The second, commitment to competence. Competence is the knowledge and skills necessary to accomplish tasks that define an individual job. Commitment to competence include management consideration of the competence level for specific job and how those levels translate into requisite skills and knowledge. The third, board of director or audit committee participation. The board of director is essential for effective corporate governance because it has ultimate responsibility to make sure management implements proper internal control and financial reporting process. Next, management philosophy and operating style. Management, through its activities, provides clear signals to employees about the importance of internal control. Number 5, Organizational structure. The entity's organizational structure defines the existing lines of responsibility and authority. And the last, human resource policies and practice. The most important aspect of internal control is personnel. If employees are competent and trustworthy, other control can be absent, and reliable financial statement will still lose up. Next, risk assessment. Risk assessment for financial reporting is management's identification and analysis of risks relevant to the participation of financial statement in conformity with appropriate accounting standard. For example, if a company frequently sells product at a price below inventory cost because of rapid technology changes, it is essential for the company to incorporate adequate control to address the risk of overstating inventory. Number three, control activities. Control activities are the policies and procedures in addition to those included in other four control components that help ensure that necessary action are taken to address risk to the achievement of the entity's objective. There are potentially many such control activities in any entity, including both manual and automated control. The control activities generally fall into the following five types. The first is adequate separation of duties. The second, proper authorization of transaction and activities. The third, adequate documents and record. The fourth, physical control over asset and record. And the fifth, independent check on performance. The next control is information and communication. The purpose of an entity's accounting information and communication system is to initiate, record, process, and report the entity's transaction and to maintain accountability for the related asset. To understand the design of the accounting information system, the auditor determines the major classes of transaction of the entity, how these transactions are initiated and recorded, what accounting record access and their nature, how the system captures the events that are significant to the financial statement, and the nature and details of the financial reporting process followed. The last control is monitoring. Monitoring activities deal with ongoing or periodic assessment of the quality of internal control by management to determine that controls are operating as intended and that they are modified as appropriate for changes in condition. The information being assessed comes from a variety of sources, including studies of existing internal controls, internal auditor reports, section reporting on control activities, report by regulators such as bank regulatory agencies, feedback from operating personnel, and complaints from customer about billing charge. And this is the table that shows the further subdivision of every component on the COSO. Next learning objective is about obtain and document and understanding of internal control. Auditing standard require auditors to obtain and document their understanding of internal control for every audit. The auditor uses procedure to obtain an understanding which involve gathering evidence about the design of internal controls and whether they have been implemented, and then use that information as a basis for the integrated audit. The auditor generally uses four of the eight types of evidence to obtain an understanding of the design and implementation of control. The first is documentation. Documentation is the auditor inspection of the client's document and records to substantiate the information that is or should be included on the financial statement. The second is inquiry of entity personnel. Inquiry is the obtaining of written or oral information from the client in response to question from the auditor. Next, observation of employees performing control process. Observation is the use of the senses of assess client activities. The auditor may tour the plant to obtain individuals perform accounting tasks to determine whether the person assigned a responsibility is performing it properly. And the last, the performance by trading one or a few transactions through the accounting system from start to finish. The performance is the auditor's independent test of client accounting procedure or control that were originally done as part of the entity accounting and internal control system. It's about the evaluating internal control implementation. In addition to understanding the design of the internal controls, the auditor must also evaluate whether the design controls are implemented. In practice, the understanding of the design and implementation are often done simultaneously. The following are the common methods of evaluating internal control. The first, update and evaluate auditors' previous experience with the entity. Most audits of a company are done annually by the same CPA firm. After the first year of audit, the auditor begins with a great deal of information from prior years about the client's internal control. It is especially useful to determine whether the controls that were not previously operating effectively have been improved. The second, make inquiries of client personnel. Auditors should ask management, supervisors, and staff to explain their data. Careful questioning will help the auditor to get the and understand their data and do what is described in the client's control documentation. The third, examine document and record. The five components of internal controls all involve the creation of many documents and records. By examining completed documents, records, and computer files, the auditor can evaluate whether information described in the flowchart and narrative has been implemented. The fourth, observe entity activities and operation. When auditors observe client personnel carrying out their normal accounting and control activities, including the preparation of documents and records, it further improves their understanding and knowledge that controls have been implemented. And the last evaluating internal control method is perform walkthrough of the accounting system. In the walkthrough, the auditor select one or review documents of a transaction type that traces them from initiation through the entire accounting process. At each stage of processing, the auditor makes inquiries, observe activities, and examine complete documents and records. The walkthrough conveniently combine observation, documentation, and inquiry to assure that the controls designed by the management have been implemented. The next learning objective will be presented by Nada.
Okay, thanks, Jerry. Learning objective 5. Assess control risk by linking key control and control deficiencies to transaction-related audit objective. Next slide, please. Assess control risk. Assess whether the financial statements are auditable. There are two primary factors determine auditability. First, the integrity of management. If management lacks integrity, most auditor will not accept the engagement. The next one, the adequacy of accounting record. The accounting record are an important source of audit evidence for most audit objective. If the accounting record are deficient, necessary audit evidence may not be available. For example, if the client has not kept duplicate sales invoice and vendor invoices, it is usually impractical to do an audit. Next slide, please. Determine assessed control risk supported by the understanding obtained. After obtaining an understanding of internal control, the auditor makes control risk assessment as part of the auditor's overall assessment of risk material misstatement. This assessment is a measure of the auditor's expectation that internal control will prevent material misstatement or detect and fix it if it has happened. The starting point for most auditors is the assessment of entity-level controls. Auditor generally assess entity-level control before assessing transaction-specific controls. Next slide, please. Use of control risk matrix to assess control risk. Auditor use the control risk matrix to identify both control and weaknesses and to assess control risk. The preparation of the matrix is, first one, identify audit objective. The first step in the assessment is to identify the audit objective for classes of transaction, account balance, and presentation and disclosure to which the assessment applies. The second, identify existing controls. The auditing use the information discussed in the previous section on obtaining and documenting an understanding of internal control to identify the control that contribute to accomplishing transaction-related audit objective. The third one, associate control with related audit objective. The body of the matrix is used to show how each control contributes to the accomplishment of one or more transaction-related audit objective. The fourth, identify and evaluate control deficiencies, significant deficiencies, and material weakness. The level of absence of internal control is first, control deficiency. Control deficiency exists if the design or operation of controls does not permit company personnel to prevent or detect misstatement on a timely basis in the normal course of performing their assignment function. Next, a significant deficiency exists if one or more control deficiency exists that is less severe than a material weakness, but important enough to merit attention by those responsible for oversight of the company's financial reporting. And then material weakness. A material weakness exists if a significant deficiency by itself or in combination with other significant deficiency result in reasonable possibility that internal control will not prevent or detect material financial statement misstatement on a timely basis. Next slide. Identify deficiencies, significant deficiencies, and material weakness. A 5-step approach can be used to identify deficiencies, significant deficiencies, and material weakness. First one, identify existing control. The second, identify the absence of key control. Internal control questionnaires, flowchart, and walkthrough are useful tools to identify where controls are lacking and the likelihood of misstatement is therefore increased. The third, consider the possibility of compensating control. A compensating control is one elsewhere in the system that offsets the absence of a key control. The fourth, decide whether there is a significant deficiency or material weakness. And the last, determine potential misstatement that could result. This step is intended to identify specific misstatements that are likely to result because of the significant deficiency or material weakness. Next slide. Communication to those charged with governance and management letters. Communication to those charged with governance. The communication is usually addressed to the audit committee and to management. Timely communication might provide management an opportunity to address control deficiencies before management report and internal control must be issued. And then management letters. Management letter is a form of auditor communication to clients to make operational improvement. Although a management letter is not required by the audit standard, auditor generally prepare them as a value added of audit service. Next slide. Learning objective 6. Describe the process of designing and performing tests of control. Next slide. Test of control. The procedure to test effectiveness of control in support a reduced assessed control risk are called tests of control. Procedure for test of control is, first one, make inquiries of client personnel. For example, to determine the unauthorized personnel are they need access to computer files, the auditor may make inquiries of the person who control the computer library and the person who control online access security password assessment. The next one, examine the document, record, and report. The third one, observe control-related activities. Some controls do not leave an evidence trail. For controls that leave no documentary evidence, the auditor generally observes them being applied at various points during the year. And then the last, pre-perform client procedures. Next slide, please. Extent of procedures. Reliance on evidence from prior year's audit. Auditing standard require test of the control's effectiveness at least every third year. Auditing standard require auditors to test some of those control each year to ensure there is relation of controls testing throughout the 3-year period. And then testing control related to significant risks. Significant risks are those risks that the auditor believes require special audit consideration. And the last, testing less than the entire audit period. The timing of the auditor's test of control will therefore depend on the nature of the control and when the company used them. Next slide, please. Relationship of assessed control risk and extent of procedure. There are two primary differences in the application of these common procedures. First one, in obtaining an understanding of internal control. The producers to obtain an understanding are applied to all control identified during that phase. Procedure to obtain an understanding are performed only one or a few transactions or in the case of observation at a single point in time. For key controls, the test of controls other than performance are essentially an extension of procedure to obtain an understanding. Therefore, assuming the auditor plans to obtain a low-assessed control risk from beginning of the integrated audit, they will likely combine both types of procedure and perform them simultaneously. This table illustrates this concept in more detail. One option is to conduct the audit separate procedures, where minimum procedures to gain understanding of the design and operation are performed, followed by additional tests. Next slide. Decide plan detection risk and design substantive tests. Auditor use the result of the control risk assessment process and test of controls to determine the plan detection risk and related substantive tests. The auditors link the control risk assessment to balance related audit objectives. The next slide will be explained by Rehan Sikiraditya.
Okay, thank you, Nada. So for the learning objective of 7, understand and section 404 requirements for auditor reporting on internal control. Next slide, please. So section 404 reporting on internal control. Based on auditor's assessment and testing of internal control, the auditor is required to prepare an audit report on internal control over financial reporting for accelerated filler public companies subject to section 404B reporting requirements. The scope of the auditor's report on internal control is limited to obtaining reasonable assurance that material weaknesses in internal control are identified. Thus, the audit is not designed to detect deficiencies in internal control that individually or in the aggregate are less severe than a material weakness. Next slide, please. So this is the types of opinion. First is unqualified opinion. The auditor will issue an unqualified opinion on internal control over financial reporting when two conditions exist. First, there are no identified material weaknesses, or second, there have been no restriction on the scope of the auditor's work. Second types of opinion is adverse opinion. When one or more material weaknesses exist, the auditor must express an adverse opinion on the effectiveness of internal control. The most common cause for an adverse opinion in the auditor's report on internal control is when management identified a material weakness in its report. And the last type is qualified or disclaimer of opinion. A scope limitation requires the auditor to express a qualified opinion or a disclaimer of opinion on internal control over financial reporting. This type of opinion is issued when the auditor is unable to determine if there are material weaknesses due to a restriction on the scope of the audit of internal control over financial reporting or other circumstances where the auditor is unable to obtain sufficient appropriate evidence. Next slide, please. Because the audit of the financial statements and the audit of internal control over financial reporting are integrated, the auditor must consider the results of audit procedures performed to issue the audit report on the financial statements when issuing an audit report on internal control. For example, assume that auditor identifies the material misstatements in the financial statements that wasn't initially identified by the company's internal controls. The following responses to these findings are likely. First, because there is a material error in the financial statements, the auditor should consider whether the misstatements indicates the existence of a material weakness. Determining if the misstatement is in fact a material weakness or a significant deficiency involves judgment and depends on the nature and size of the misstatements. Second, the auditor can issue an unqualified opinion on the financial statements if the client adjusts the statements to correct the misstatement prior to issuance. Third, management is likely to change its report on internal control to assert that the controls are not operating effectively. And the fourth one, the auditor must issue an adverse opinion on internal control over financial reporting if the deficiency is considered a material weakness. Next slide, please. So for the learning objective 8, describe the differences in evaluating, reporting, and testing internal control for non-public companies. Next slide, please. So this is the following identifies and discusses the most important differences in evaluating, reporting, and testing internal controls for non-public companies. First, reporting requirements. In audit of non-public companies, there is no requirement for an audit of internal control over financial reporting. The auditor, therefore, focuses on internal control only to the extent needed to do a quality audit of financial statements. Attestation standards provide guidance when non-public entities engage the auditor to conduct an examination of the design and operating effectiveness of internal controls over financial reporting that is integrated with the audit of the financial statements. The approach of an integrated audit for a non-public company under the attestation standard is consistent with the approach to an integrated audit of a public company under PCAOB Standard 5. The auditor is required by auditing standards to issue a written report on significant deficiencies and material weaknesses in internal control to those charged with governance and management, the same as for public companies. So this is the example of the letter regarding significant deficiencies in internal control. In this letter, there are a significant deficiency is a control of a deficiency or combination of control deficiencies that adversely affects the entity's ability to initiate, authorize, record, process, or report financial data reliably in accordance with generally accepted accounting principle that is less severe than a material weakness, yet important enough to merit attention by those charged with governance. And also here in this letter, auditor consider the following deficiency to be a significant deficiency in internal control. Next slide, please. Second is extent of required internal control. Management, not the auditor, is responsible for establishing adequate internal controls in non-public companies, just like management for public companies. If the control environment or documentation is inadequate, the auditor may decide to withdraw from the engagement or issue a disclaimer of opinion on the financial statements. Also, well-run public companies understand the importance of effective controls to reduce the likelihood of errors and fraud and to improve effectiveness of efficiency. A company's size has a significant effect on the nature of internal control and the specific controls that are implemented. It is certainly possible for a small company to have first, competent, trustworthy personnel with clear lines of authority. Second, proper procedures for authorization, executions, and recording of transactions. Third, adequate documents, records, and reports. Fourth, physical controls over assets and records, and to a limited degree. And five, independent checks on performance. A major control available in a small company is the knowledge and concern of the top operating person, who is often an owner-manager. A personal interest in the organization and a close relationship with personnel make careful evaluation of the competence of the employees and the effectiveness of the overall system possible. For example, internal control can be significantly strengthened if the owner conscientiously performs such duties as signing all checks after carefully reviewing supporting documents, reviewing bank reconciliations, examining accounts receivable statements sent to customers, approving credit, examining all correspondence from customers and vendors, and approving bad debts. Some of non-public companies are unwilling to implement ideal internal control systems because of cost. For a small non-public company, hiring additional personnel might achieve only small improvements in the reliability of accounting data. Instead, it is often less expensive for non-public companies to have auditors do more extensive auditing than to incur higher internal control costs. Next, please. Third one is extent of understanding needed. Auditing standards require that the auditor obtain a sufficient understanding of internal control to assess control risk. In practice, the procedures to gain an understanding of internal control vary considerably from client to client. For smaller non-public clients, many auditors obtain a level of understanding sufficient only to assess whether the statements are auditable and to evaluate the control environment for management's attitude toward internal control. If the auditor determines that the overall attitude of management about the importance of internal control is inadequate to support the other four components of internal control, the auditor assesses control risk at maximum and designs and performs detailed substantive procedures. For larger clients, the understanding can be the same as the described for public companies. Fourth, assessing control risk. The most important difference in a non-public company in assessing control risk is the assessment of control risk at maximum for any or all control-related objectives when internal controls for the objectives are non-existent or ineffective. Because of the expectation that public companies should have effective internal controls for all significant transactions and accounts, there is an initial presumption that control risk is low in the audit of public company financial statements. Thus, it is unlikely that a public company auditor will make a preliminary assessment of control risk at maximum. Next slide, please. And the last one is extent of tests of controls needed. The auditor will not perform tests of controls when the auditor assesses control risk at maximum because of inadequate controls. When control risk is assessed below the maximum for a non-public company, the auditor designs and performs a combination of tests of controls and substantive procedures to obtain reasonable assurance that the financial statements are fairly stated. In contrast, the number of controls tested by auditors to express an opinion on internal control for a public company are significantly greater than the tested solely to express an opinion on the financial statements. And here it is the example of differences in scope of controls tested in an audit of internal control and an audit of financial statements. Here, the internal controls over financial reporting has controls that must be tested in an audit of internal controls. And also in this internal controls over financial reporting, there are internal controls used to assess control risk below maximum. It is the controls that must be tested in an audit of financial statements. Back to Richard. Thank you.
Okay, thank you for your explanation, Raihan. And that's all about our presentation. Thank you for attention and wassalamualaikum warahmatullahi wabarakatuh.